Panda Anthem.
Ian, what's up?
Red Panda Anthem.
Red Panda, what's good?
Red Panda Anthem.
You want to identify what are the best prices for the best companies, and baby, focus on the top 5. I know everyone's going to tell you something different, but trust me, focus on the top 5 and mark off where the 80% off line is. You want to put majority of your capital there. 90% is great, but not every great company is going to get there. For a top 2 company, top 3 company of that decade, 50% may be the area, but that's the formula. Everyone's going to ask you. And for those of you who are listening, how do I know when to invest? When it's 90% off, when it's 80% off. And if you're looking at a 10-year chart and it's off 90% off of its highs and it still has great value, if you're holding it for 10 years, but the biggest issue is, baby, that most people, Xander, will not hold for a long period of time. You won't make that mistake. So remember when we were talking, you're like, but I want to have money and I want to do different kind of careers and jobs, but I don't want to have to just do one. This is the blueprint to be able to get you there, because then you can take this cash and then you can borrow against this liquidity from these stocks at a low interest rate. And even in a higher interest rate environment, the loan shouldn't be more than 3.5% to 4%. And then you can live potentially off of that loan, pay that money back, and still have your stocks available. A good way to know if we are at a high value place where the market could drop is the Wilshire versus GDP calculation. I'll show that to you. So this is the Buffett indicator. You can find it on longtermtrends.net. I have no relationship or affiliate partnership with them. But in these levels down here, so this gray line is the mean, or where it should average out at. When we're sub the mean, almost 50%, you want to load up heavy here. This is 2008. So if you look in 2020, we were still really high. It's still really high. It was at 124%. When it got to 200%, we were going to start to see some tapering. And we talked about this before on Market Mondays. And I'm looking at all the data. But even if you go over a 30-year period, you can kind of see 2007 was here, 2009 was here. We were overinflated. So anytime we start to hit these major levels, 150%, 200%, that's when you're going to notice start tapering off. Also, too, if you look at what the all-time highs are, especially if there's no quantitative easing, you want to start to ease up. So on a decade-by-decade basis, when this is underneath the mean, so sniper, same with the EMA, you would be, so let's say you got into 2003, right here. You've been great to 2007, you would have went under. Let's say you would have re-entered back in 2011. From 2011 through now, you would have had tremendous gains. This is all about playing the long-term game and having a strategy. But if you look at this Buffett indicator, it'll give you an indication for when you should be buying and when you should stop to taper off. So when it gets to 150, 200, 250, you want to stop your buying. That's not the best place to buy. You want to buy low down here and then exit potentially at a high. The next lesson is you want to invest more during low interest rate eras or when there's extreme quantitative easing, like it was in 2008 through 2022. And be selective when rates are higher. So if interest rates are incredibly high, stocks won't give you, or companies won't give you as great of a return. So not only do you want to buy low and sell high, you want to buy heavier when interest rates are at a lower rate opposed to when they're at their peak. Okay? It's easy to make returns on 0% capital loaned to you. How many, if I gave you $1 million, or somebody gave you $1 million at 0% and say, hey, you can pay back when you want to. You can find a way to make money off the million, right? That's how the housing market was and stock market was. And now the interest rates are going up. It changes the dynamic a little bit. When trading, next lesson. If you're going long and you don't want to get prematurely stopped out, put your stop at the bottom of the current low of the day, only if the trend is green. Xander, I know you're going to listen to this. I don't know about everybody else. But put your stop at the bottom of the market so you don't prematurely get whipped out, only if the market is then going upward. Green means up, red means down, right? And then if you're short in the market and the market is red, put your stop at the top of the market so you don't get prematurely whipped out of your move when you're shorting. Exercise discipline in every trade. Don't deviate. Don't adjust your stop. Once you lock in profit, get up, walk away. You can hit your targets, make the monies you need, and be incredibly happy. Next lesson. You have to learn to love the speed of the downtrend of NASDAQ and Dow when the market is crashing. So, yes, your long-term portfolio may be getting beat up, but don't look at it. And your short-term portfolio, you should be able to take advantage of these waves. And if the market is consistently moving down, if you're trading to the downside with it, it should offset the losses that you're having in your long-term portfolio. There's a group of safety stocks that you're going to be able to invest in, Xander. So normally pharma is going to be one area you can invest in, and you put these together. One is going to be two is technology. So pharma, a top technology company, a top retailer, and then a top consumer good company. So in times of stress right now, if you need 4 more to invest in, a company like Eli Lilly would be really good, right? And then if you needed a top technology company, I'm going to lean on Apple or whatever the number 1 brand is at the time. Number 3, if you need a top grocery or retailer, I will go with Costco, Walmart, or Target, but I like Costco a lot. And if you need a top consumer good company, I would lean on Procter & Gamble. Next lesson, you need to read the top 10 books in every industry and the top 100 books of all time. Most people don't have an edge in business because they don't have enough intellectual data at their fingertips. And even if you're feeling tired, Xander, squeezing 2 pages a day. But if you learn something from every industry, so learn some from mom in the medical field and some from me in investing in business and some from grandpa in business and construction, right? If you learn a little bit every day, it is going to make you a superhero intellectually. And as many times as I tell adults this, they don't listen, but I know that you will. Next lesson. New financial products are created when we're close to a collapse. So Bitcoin was created right around the time of the 2008 crash. NFTs were created around the time of this current crash. When there's stability in the market, there is not a need for new products in the ecosystem. When you see a bunch of products starting to pop up, it is because there's instability in the financial markets. Be careful in how you invest in them. Put 5% of your capital into them and test them out. Learn about everything. Don't ever turn any asset class away. But your allocation has to be set based on the ones that are going to give you the highest return with the least amount of drawdown or risk. The next lesson I need you to learn, the average time to recover in a bad crash is either 1,213 days or 2,500 days. And every month through each of those, if we go through an extended recession, I want you to invest every single month. Invest through the suffering. Next lesson, you have to use your day trading setup to get into your long-term positions. I don't want you trading. 90% of your money should go to long-term. But if you are able to use the setup, baby, that I gave you, off the time frame that I gave you, you'll get some good entries into Tesla, Apple, Amazon, Google, AMD, Procter & Gamble, Lilly, etc. And you'll be fine. I said it before, but you need 10,000 shares for freedom for yourself. And ideally, throughout your life, by the time you're 40, you want to have 150,000 to 500,000 shares of top companies for generational wealth. So during the 1929 depression and crash, John Templeton bought 100 shares of every company that traded for less than $1, which is a company's almost bankrupt. And I would adjust that for now. I would do in this era 1,000 shares in the top 4 industries that have fallen 90% from their all-time highs that are older than 5 years old. If you can get them between 80 to 90% off and get 1,000 shares and just load the boat and hold for a 20 or 30 year period, you'll be okay. And this is the matrix that you have to be invested in by the time you're 25. You have to have index funds, tech stocks. You have to be investing in businesses and companies, in angel investing, venture capital, private equity. You have to flat out, outright acquire companies, either small or mid-sized businesses. You have to know the top 20 commodities and how they trade and fluctuate, because there may be a gap that you're able to trade or invest in that would give you a ton of money. You have to master short-term investing, and I know you'll do incredibly well at that. And then you have to focus on one thing that you love to do and tie them all in together. That's why I always tell you, I don't care what you want to do for your career. I want you to do what you love, but you can tie these things in and be free and not have to deal with politics or opinions, or not go to the meetings you don't want to if you are heavily invested into the companies that are there to pay you. You want to take your dollars and make your money make more money, babies, so you don't have to waste or spend your time doing things you don't want to. Last lesson I want you to know is that investors and traders like or hate uncertainty in the market. So uncertainty creates volatility. Volatility creates risk. Risk creates fear. Fear then causes selling. Selling causes losses, and then when uncertainty ends, the bull market returns. This is why I tell you, entrepreneurs, every company right now, angel and venture, is looking for the next big thing. We have to solve some real problems to get to some real money. We don't need another social media app. And the last thing, Xander, a lesson from Templeton: buying at the point of maximum pessimism is critical to investment success. And I would only say you want to invest in a company when it's most pessimistic, but it has to be a quality top 10 company. And when everyone's saying, no, this isn't going to work and this crash is going to be different than others, that's when you want to put the majority of your money in. And when you finally get married, I want you to follow this Pleasant principle. Kudos to Dr. Pleasant. I want you to take one income and solely invest all of that for a 15-year period. It's one of the easiest formulas ever to becoming a millionaire. If you are married to someone, both incomes should not go to bills. One should go to investing and one should go to taking care of the household stuff. Now, baby, by the time you get married, you should be well off. But I still want you to follow these rules. And lastly, you can beat 99% of people in the world and be one of the most dominant and financially free people ever, just by following your plan and not deviating. I love you dearly. Recessions, depressions, crashes are a chance to build wealth like no other time. And with this great reset happening, if you don't learn how to invest short-term and long-term, you are setting yourself up to be susceptible to whatever they choose to do with you financially. You have to be able to produce profit at all costs in any markets, and no one is going to have sympathy if you cannot. And those are the top lessons I would give to my child forever, and to you.
This that Red Panda Anthem.
Ian, what's up?
This that Red Panda Anthem.
Rap Panda, what's
This
good?
that Red Panda Anthem.
It's your
Whole
boy.
clip going up. I know they can't stand it.